Hi, I'm Smriti Popenoe, the co-CEO and president of Dynex Capital. I'm here today with TJ Connelly, and we're here to give you a hot take on this week's Fed meeting. So TJ, why don't we start with what was unique about this meeting and a discussion about the actual reaction versus what the market was expecting.
Yeah, this was the first meeting with a new FOMC member, Stephen Moran, who was recently appointed by President Trump, and certainly is perceived to come with more of a political bias than many of the voters we've had in the past. The Fed produces a dot forecast of where they think policy rates may go. It appeared that Stephen's dot was the one that's likely below 3%. And that's important because the cyclical nadir that the market had been forecasting was right at 3% in the first half of 2027. So it certainly will make people think maybe we need to think about pulling that forward a bit.
Yeah, and it seems like that 3% is a bit of a psychological level. So having that dot below 3% at 2 7/8 is meaningful because now you have a 2 handle on something.
Absolutely.
Yeah, so let's talk about mortgage rates. You know, at Dynex, we've talked a lot about like the shape of the yield curve and how when the Fed does cut rates, that it may not necessarily affect the back end of the yield curve. What has the yield curve been doing, and what have mortgage rates been doing in this last go round?
Right, over the course of the last 2 quarters, the policy rate forecasts have started to come down, matching what we're now seeing from the Fed's dot plot. As that's happened, the yield curve has steepened, but the policy rates have come down enough such that those longer dated rates, such as a mortgage rate, have come down. So the mortgage rates come from above 7% to around 6.5%, and that sparked some real interest in refinancing, which is obviously very important to us and things we think a lot about at Dynex. And the refi index in the last week has jumped dramatically, and it's even jumped more than previous episodes when the mortgage rate hit 6.5. So it's indicating that there's tremendous amount of pent-up demand for refinancing mortgages.
Yeah, so if you're out there looking, you know, you're a homeowner and you have bought a home or refinanced in the last year or so, you know, these are attractive rates, and we should expect to see refinancings really pick up here as these interest rates get passed through. Let's pivot over to fixed income. I mean, we've made the comment in our previous episodes that real yields, that is the return you get after adjusting for inflation, are actually quite high relative to history. And that fixed income is actually a reasonable, in fact, attractive alternative relative to many other asset classes. So, and we've also talked about diversification. So comment on those in terms of like what is really the opportunity here?
Yeah, the real yield level is very important. A real yield is the yield that you can earn relative to inflation. And as you point out, that's positive in many parts of the bond market, such as mortgages. As we relate it back to the policy discussion we were just having, there's certainly a bias by some policymakers to cut the Fed's policy rate to a negative real yield. We've spent a lot of time there in the last decade at negative policy rate, real policy rates. So to the extent that you can invest in real yields that are positive today with the potential that policy rates in the future are negative, makes fixed income very compelling at this point. And we've seen very strong, solid fund flows into fixed income mutual funds and ETFs, also life insurance, annuity contracts, things of that nature that are all taking advantage of these positive real yields.
Yeah, so it almost seems like the focus on yield is really present at this point. Diversification into yield-oriented instruments like Dynex stock, for example, with a 16% dividend yield. All of that is in the mix for many investors. Let's pivot over to our thought process here at Dynex. You know, we think about things in terms of short, medium, long term, and then the fundamentals technical psychology framework that we've used for a long time. Talk about the short term, what's your focus, and then medium and long term.
Yeah, in the short term, there's a host of global considerations. We take, as you said, we take a very top-down approach to policy, and I think that as we move forward, the Fed's dot plots have given us a bit more comfort that we're very likely to see cuts in October and December.
Yeah.
And then more broadly, we're thinking a lot about things like deglobalization, more onshoring of U.S. production, things of that nature. So the macro matters tremendously on a day-to-day basis. When you're looking at the Fed and things like that, it may not feel like it, but that's something we focus a lot on.
Great. Yeah, I always I always like putting you on the spot to see if you're going to predict something. But as we always say, we don't predict, we prepare.
Exactly.
And that's the discipline that we have here at Dynex. Our team is focused on managing our shareholders' capital with the discipline processes that we just talked about. And until we have the next Fed meeting or any other market moving event, we're here managing our shareholders' capital with that mindset. And we'll look forward to seeing you then. Thank you.